everyone. Recently, there's been a little bit of short-term volatility in the market. And so we thought, with having a lot of questions from advisors about what's happening in the world and things like that, we thought that we'd film this video just so that we can give you a bit of thinking on how we think about it and how it's spilling over into our investment philosophy. And also it will be a nice tool that you can send to your clients as well if they have any questions. So Paul, our CEO at New Road Capital, has joined us. Thanks, Paul.
Thanks for having me, Jess.
One of the first questions is this recent Chinese regulation crackdown and sort of Evergrande as well, and how that's going to play out in the market.
Yeah, so Jess, it's it's obviously been a story for a while, but I think it's obviously sort of coming to a head now with the whole with what's been happening with Evergrande and the property sector in China. But if we go back a little bit, we realize China has liberalized its economy over the last 30 years quite extensively. And through that, through embracing capitalist economic ideas, have created quite a lot of wealth in China. And over the last few years, you've actually started to see that turn around a little bit, and the government, specifically under Xi Jinping, has sort of has almost brought a slightly more authoritarian stance to how things are going in China. So clamping down on a lot of the economic liberalization that they've had in the last 30 years. And there's been a few things. We've obviously seen the anti-monopoly, the tech crackdowns, and that's obviously affected things like Naspers and Prosus on our market. So that was the one thing. You've seen certain after-school education or the after-school care sector in China has essentially been almost dismantled. It's become sort of, you're not really allowed to make profits in that industry anymore, so that's affected that industry. And then the property sector, what really has been going on there, and Evergrande specifically, is through this liberalization you've had massive amount of debt being taken up as China's economy has grown and as wealth has been created in the private sector. A lot of investments have moved into property, and a lot of these companies, Evergrande being one of them, and that's the second largest property developer in China, has taken on a lot of debt to fund its portfolio in China. And what happened with regulations a few months ago was that China put in specific limits on how much debt these property companies can have. And there's a few of them that are out there, and with the debt that these property companies were allowed to have, that's obviously created a little bit of an effect on the value of properties and on the outlook on properties going forward. And that's caused Evergrande to fall into a little bit of a hole now, because it's got a massive portfolio, but its debt, it's got a ton of debt, and that it can't really fund that debt. It can't really service that debt now without help. So the fear is, what's going to happen is it's going to cause contagion around the world. Now, if you look at their debt, it's about $300 billion that they have on their balance sheet. Of that, only about $20 billion is actually offshore debt. So that would be offshore bonds, from offshore investors holding that, which, to give you $20 billion is about 300 billion rand. It's a lot of money, but to give you an idea, that's less than what Eskom owes right now in rands. So it's not going to be this huge contagion spillover. Where it will affect the Chinese market, and it's already had effect on property prices, is local investors. So there's local investors that have been wanting to invest in property, or that have actually given or invested with Evergrande and haven't received the property yet. So Evergrande now trying to service its debt. It's also brought the property market down because it's trying to flog some of these properties off back to shareholders, back to investors. A lot of their wealth management clients are involved in that too. It's predominantly a property business, but it does have some sort of subsidiary businesses. So we don't see it as being a massive contagion effect on the market. It is going to affect China. Where the potential risk could be is that if it has an effect on China's economy going forward, and not just the property, but if you look at the authoritarian move that's coming out of the Chinese Communist Party over the last few years and months, that could have a negative impact on economic growth in China. I think we're already seeing that. You've seen China growth still growing at about 5%, but it's come off quite a bit from where it was. That could have an effect on, for example, commodity prices, which would affect our miners, for example. So that's something that we're monitoring at the moment. But in terms of an actual contagion effect regarding Evergrande, we're not concerned about that. But in terms of the risk management side, in terms of what China has, how China in general, how they sort of fit into the global macro, that is a concern for us. If you look at our portfolios, as you guys know, we like to use a lot of passive investments in our portfolios as well as active. If you look at the active equity funds we have, they don't have any exposure to China, so there's no exposure to NASPers or Prosus or anything like that. From a passive side, we do have some limited exposure to NASPers and Prosus, but those prices have already come off quite a lot, and we actually think that there's still a lot of value in those businesses, and so we're happy to own the passives in our products. If you look at the offshore side, we do use the iShares Emerging Market passive tracker, and we use it for a lot of reasons. One is obviously the cost, and also it's a well diversified passive tracker. We like it in our portfolio. That has within that tracker, that has about 31% exposure to Chinese equities in general. But if you look at Chinese equities, Chinese equities have been sold off quite a lot in the last few months. So we actually still think with all this risk, there's a lot of value. So if you look at our portfolios, our fund with the most Chinese exposure, if you look at offshore Chinese exposure as well as NASPers and Prosus as Chinese proxies essentially, our managed fund is about 5% exposure if you include the NASPers and the offshore. So we're not too worried. Our exposure is very limited. If you look at our global flexible fund, it's about 4.5% exposure to China specifically. We've got a lot of developed market equities that we're not exposed to Chinese property at all. We think that's probably the biggest risk to that the biggest sector at risk in terms of what's happening with China now. So we don't have any exposure to Chinese property. So we're quite happy with how our portfolio is positioned from that point of view at the moment.
All right, perfect. And then the second question that we've been sort of asked from advisors and clients then obviously is the Fed and their hawkish view on interest rates, and how that's sort of going to spill over into our market as well. Yeah,
so I think that's probably the bigger contributor to global equity moves at the moment. If you take China out of the picture, if you look at developed market equities. So there's two elements here. The one is the Fed tapering. So you must remember the Fed has done has put in three stimulus, and the same can be said for the European Central Bank as well. But there are essentially three sort of stimulus pillars, if you want to call that, coming out of COVID. The one is the fiscal stimulus, which is the spending. But then if you look at the monetary, you've got sort of two factors there. The one is interest rates being kept low. And then you've got the bond buying program, the quantitative easing, which is where the governments are actually buying bonds. So if you look at the Fed at the moment, they are still buying about $120 billion worth of bonds every month at the moment, just to keep that bond market afloat, or to keep money coming into the system. And they've got interest rates, setting the Fed funds rate at the moment, it's between the target rate is 0 to 25 basis points, so rock bottom. So there's two factors here. So what Jerome Powell has said is, looking forward, he thinks that the economic growth will be strong enough that they can stop or they can start reducing tapering in about November this year. They want to look at, so from that $120 billion that they're buying into the bond markets every month, they want to reduce that by about $15 billion a month, every month, starting in November. So as a percentage of the $120 billion, it's not a lot every month, and they'll start tapering that buying off and hope to be finished sort of around mid next year. That's the plan at the moment. This can change. But that plan is actually quite bullish if you think about it, because what they are saying is they're coming out and they're saying that economic growth is strong enough that they don't need to do this anymore. So we actually think it's quite bullish for markets. I think in the short term, it's potentially created a little bit of jitters in the markets. Your weak holders might be sort of leaving the markets, but long term, if you look at where earnings are in the US and actually funnily enough in Europe, very strong at the moment. They're coming out, the economic recovery is on full tilt at the moment. So we're very happy with how things are going there. And at some point, the Fed does need to start pulling back and normalizing their monetary policy. So we think this is a good stance. Powell himself has said, though, if things start turning around, that they will obviously discontinue that tape and probably become more accommodative. So that's the one aspect. The other aspect is the actual interest rate. So the short-term interest rates that have been set. So like I say, at the moment, they're between 0 and 25 basis points as the target rate. Very, very, very accommodative. They are not talking about raising those rates anytime soon. If you look at the Fed dot plot, which is the Federal Open Market Committee that meets, that meets every few months, that is, if you look at that, about 50% of them are only looking at raising rates, sort of late next year. So that's not a concern. So if you look at rate monetary policy from rates still very accommodative there. That will keep the economy growing. It's just the liquidity that's being provided into the bond markets that is being reduced, but for good reasons, because the growth is there now to kind of sustain itself, and we don't need this extra capital injection into the monetary system. So I think we're quite happy with how things are looking in sort of global equities. As you know, in our portfolios, we're already on the conservative side with equities in general. We remain being conservative with equities in general. If you look on the bond side, we still like local bonds. We still think that there is a lot of upside. There's a lot of real yield in our markets, in our bond markets. If you look at inflation, numbers coming out, inflationary numbers have not been, they've still been elevated, but they're not increasing from where they were a few months ago, and you'll probably start to see those coming down. There are still some supply chain issues in the world. I mean, if you can see the sort of gas price issues, natural gas price issues we've got in the UK at the moment, or around the world at the moment, that's really a supply issue, and that should kind of sort itself out in the next few weeks or in the next few months. So we're not really worried about inflation at the moment. We still think global developed market equities are offering good value. Although they've run really hard, earnings have been supporting that, and earnings have actually come out and they're surprising on the upside. So we're quite happy with earnings globally. So I hope that sort of allays some of the sort of worries and the talking points that you've been having with advisors.
Perfect. Yeah, thanks a lot, Paul. I think that will help advisors a lot and help them deal with their clients and be able to answer some of their clients' questions. But thanks so much for watching, and please be sure to ask more questions so that we can have more of these sessions.
Thank you, guys.